Hi everybody, we are going to continue with the next chapter this week, Chapter 14. We have cost planning, and actually this will be our last chapter of the semester, as we actually will not do Chapter 16, and we will conclude with cost planning for the semester. And we will have the exam coming up on December 6th, as the syllabus states, and that will be the same format as last time, and the chapters on the exam will be 8, 9, 12, and 14. So we're going to have 4 chapters, a smaller exam, and similarly about 5-6 questions per chapter, around 25 total questions for this one. So in the meantime, I wanted to go over the items for cost planning. And essentially, what we're doing here is we're looking to plan out these costs. So, in a way, the idea of cost planning is really the idea of measuring your performance. It's all about connecting to budgeting, connecting to setting budget goals, measuring budget goals, and improving performance. How can you evaluate performance in your business? And you could do that using budgeting and then assessing whether you stayed on budget or below budget or above budget. But the idea is to improve performance, and it doesn't have to be actually dollar amount. It could be customer service levels. It could be on-time deliveries, on-time flights in the flight industry. It could be higher utilization in the accounting or legal industry, and it could be in government, better use of funds, more efficiency in utilizing funds, better quality in delivering social services. In nonprofit, it could be simply better outreach and higher value delivered to the beneficiaries. So it's really about the efficiency in using resources, is what we're talking about, the cost planning. And what we talk about initially, we'll talk about the budget and how does the budget work, and basically the definitions of a budget. And basically what we look at first is the budget time frame for the operating budget. And essentially a lot of times in industry they'll do a budget for the year ahead, and every year they'll renew it. Or a continuous or perpetual budget is every quarter they go for the year in advance, so they update the budget every quarter. The idea with budgets, we'll get into this more, but the idea is that you want to have your budget to be as accurate as possible, including all the latest feedback from the business, whether there was changes in different charges, or whether there's going to be a higher sales this year, or a different marketing drive, or a different macro event, or a market size share. These are the type of things that can go in a budget, but the idea is that you want to put a lot of work and effort into creating your budget so that it is a quality instrument, that is really a live instrument that encapsulates all the relevant changes from last year, and not just copying last year's budget forward to this year or to the future year, but rather really working with managers, with people in the field, people who are close to the numbers, close to the business, of what they are anticipating. Why? Well, mostly because it's a matter of, budget is a tool of measuring the performance of managers. So of course that if you do better than the budget, then you get rewarded as a manager. If you do worse than the budget, then of course you get penalized. So of course you don't, in that sense, You want to have budgets that are really reflecting the performance of the business. And another thing is that budgets are not the only way of assessing the performance of the business. There are other ways to do that, including non-financial indicators are basically aligning more to the strategy goals of the business and to the overall performance of the business. That's not just financial. So just with these couple of slides, what we're talking about is that a budget really depends on different inputs such as variable costs, fixed costs, and your sales, and then the operational expense budget, which is at the bottom line of that. Um, we have budget income statement, budget statement of cash flows, and budgeted balance sheet is what we're trying to basically come up with as in a way a product of ours. So with all of this in mind, um, what I really want you to focus on, we're not going to go over the production budget with the units and everything. I want to kind of skip that because that's honestly something that takes 2 weeks to go over in cost accounting class. So I'm not just going to put that in as a passing item. But looking at the next topic here, the budgeted income statement is something that we can look at and just kind of see that they come up with budget income statement of basically sales, cost of goods sold, and then we can come up with total unit cost that we put in there, and we can look at basically the whole income statement. Budgeted income statement is really the point of here. We have sales, we have cost of goods sold, gross margin, selling and administrative expense, operating income, and net income. This is basically budgeted income statement for the coming quarter, essentially. So that is something that people do for their business in order to really get comfortable with what's going to happen in the next quarter. You could have a cash receipts budget, which is basically a budget of how much cash you have coming in, and that is basically you want to make sure you can pay your bills, and that's something that of course is essential. I'm sure you do that on a personal level, and honestly, cash payment for materials budget, for purchases budget, comprehensive cash budget. This is all these things are just a function of doing something that we do for income statement, for balance sheet, for cash flow statement, but for the forecasting. That's all it is. We're forecasting numbers into the future. And honestly, the best way to connect to this is, if I'm sure you've done this already, and there's so many apps to do this, but you do your personal budget. Have you ever budgeted for the 3 months ahead? Have you ever budgeted for the year ahead? Of course you have. And if you haven't, it's actually a really insightful exercise because it really tells you where you're going to be and how you can either save or make changes to what is going to be happening. You come up with a budgeted balance sheet, and all that really means is, where does the accounts fall out from your income statement? Where does that remain? Is it going into assets? Is it going into cash? This is really what a budget is, and that's all we're really talking about in this chapter. And the other piece that we get into is standard costs, which is essentially costs per unit. It's basically determined amounts of what goes into a single product, and including the overhead. And in the book they have the example. If you go to the book on page 526, 527, they have an example of all the different costs going into producing one of the boats that we've been discussing in the last couple chapters. And this basically shows you how to allocate not just the direct materials, raw materials, direct labor, and then also the variable overhead and the fixed overhead costs that go into a single boat. And I know we've been working with that example, so take a look at that to see. And you basically come up with a per unit cost because they're standardized every cost on a per unit basis, and then they apply it to every unit produced, and it's a good way to see what is a standard cost. And Again, standard costs can also, how can you apply them? There also can be other standards, not just cost, but it could be standards of safety goals, sales levels, training levels, quality control, inventory control, machine usage. So you can set basically an idea of where you want to be at a level of a process and use standards to get there. And that's ultimately what this chapter is all about. It's not just about the dollars of it all, but rather setting a certain standard and measuring the improvement so that you could get there. And I think that's how you can achieve a lot of continuous improvement and overall success in strategy and business.